I think one of the next frontiers that's major for real estate is the sub-institutional multifamily. You took care of the one unit properties, but the 2 to 75, the 2 to 100, the 2 to maybe 200 unit properties, that is a space that's very difficult to get institutional level quality access to. And that's our long-term mission, is doing that. It's very motivated for sure. I won't lie to you about that, but there's a lot of benefit that brings to the community and the resident base.
Welcome back to the AI Edge podcast, where we sit down with operations, investors, and capital partners who are shaping the future of commercial real estate through strategy, system, and innovation. Today's guest is someone who brings a rare combination of institutional pedigree and entrepreneurial execution. Ray Hyman is the managing director of Terra Capital, a private equity firm focused on sub-institutional value-add multifamily across Midwestern markets. Before Terra, Ray cut his teeth in the institutional world at JP Morgan, Strategy and Service Capital Management, giving him a deep foundation in rigorous underwriting, macro analysis, and operational execution. At Terra Capital, he is applying his discipline to an overlooked corner of the market where inefficiencies are high, yield is still accessible, and small mistakes can make or break a deal. Ray, welcome to the show.
Thanks. Very glad to be here. Thanks for having me.
Great to have you. So, Ray, let's start off with your path. You got into macro research, banking, consulting, and private equity is in your background. When someone asks you, how did you end up in real estate private equity? How do you usually answer that?
Yeah, so I have done some corporate work, but the vast majority of what I've worked on is in real estate. So when I was at JP Morgan, I was on the US real estate and REITs desk. When I was at Booz/Strategy, and I did a lot of real estate work there, but I did a good amount of corporate as well, probably 50-50. And then at Terra Capital, I was doing a pretty good amount of real estate as well. I actually started working on Terra Capital while I was in school. So I've been doing it for a long time. And I started in what was my backyard at the time, New York City, and did a bunch of smaller deals, 3, 4, 5, 6 unit deals. To this day, the largest one done in New York is 20 units. And at the time, it was a reflection of there's only so much capital available for somebody who's 21, 22 to put deals together, and a 3 or 4 unit building in New York is still a pretty good chunk of cash. That was kind of how that started. It really illuminated this underserved part of the real estate market, especially in multifamily for these smaller properties. I mean, 80% of the multifamily housing stock in the US is in buildings that are 50 units or less. And in some cities, that's even more extreme, where there hasn't been a big, large-scale developer boom that put in a bunch of 250, 300, 400 unit apartment complexes. So there's a vast sea of these properties. Even in New York City, where it's pretty competitive, there is a lack of attention to everything from management to renovations. There's just so much that's left on the table that a kid with no prior background could come in and add value through renovations and end up exiting very well and operating at very high cash flows. I think New York became a place that was very difficult to operate from a regulatory perspective. And that's what originally got us looking at some Midwest markets. And now we're in Pittsburgh, Columbus, and Indianapolis, but really applying the same logic, going after the smaller properties. Now we've gone from the 3, 4, 5, 6 unit ones to really anything that's below 200 units is in our strike zone. And our sweet spot is kind of that 100 to 125 units, where it's just on the verge of needing a full on-site staff, but it still can be managed as a scattered site portfolio. And that's the part of the market where there's a ton of inventory. It is very underserved, and there's relatively little competition for what we do, which is renovating older product. And I think when you look at an environment with raising interest rates and a lot of competition around multifamily and people trying to get you to close on a deal in Dallas that's a 3.5% cap, which, far be it for me to comment on that. That might be a good deal. I don't know. I don't work in Dallas, but As far as I'm concerned, what gets me really interested is a place where I can stabilize in a high eights, low 9% yield on cost, where I can exit a fully cash flowing product or portfolio in that 6% or below, and really take advantage of the arbitrage there, but also be meaningfully above where debt service costs are, so that if interest rates come up a little bit or there's more vacancy for XYZ reason, I'm not in a position where I have a debt faced cash trap. So for our strategy, it's really, let's pick these three markets that work really well. And I can go into detail on why we like these three, but have big opportunity: Columbus, Pittsburgh, and Indianapolis. Let's go after the properties that need a meaningful level of value add. So 30% of the dollars we spend are in renovations. And then on top of that, let's only look at the relatively small ones where there's not big national competition over it. And when you combine those three things, it's a lot of blood, sweat, and tears to make it work. But you do get yourself to 9.25% yield on cost, which is, it makes it worth the squeeze at that point.
That's fantastic. I love your strategy. That's awesome. Great business model. So what made Terra Capital the right platform for you? What gap did you see in the sub-institutional multifamily space that larger firms were overlooking?
Yeah, so it's the yield opportunity at the end of the day. If you do the things that I was saying, you can get to those higher yields and then bundle up properties in a portfolio, or if it's a 150 unit asset, sell it standalone, and really take advantage of pretty meaningful arbitrage between your 9% yield on cost and your 5.5, maybe 6% cap rate at exit. So that's what attracted me and Terra to that part of the market in the first place. But I think what has really kept us excited is just the vast opportunity, the number of properties that are underserved. I mean, there's 10,000 addresses in each of those cities. So 35,000 addresses total that fit our strike zone. Some of them are smaller, 5, 10, 15 unit buildings, which we still take down on a regular basis. Those can be fantastic deals. But there's so much there that is underserved from a management perspective. It's underserved from the lender community. It's hard to find lenders that do that. It's underserved by the legal community. There's not a fixed set large law firm that takes care of these smaller properties. And you can go down the list. I mean, the number one thing that's most difficult is contractors that can work on smaller deals and have teams that are set up for, doing 15 units at a time instead of 300 units at a time. And it's just a part of the market that is lacking in operational fluency, and it's lacking in management oversight. So it was a natural place to attack. I think it's very similar to how corporate private equity funds will go after a roofing company with $5 million of EBITDA, and then buy 6 more roofing companies, put it together, get to 30 million of EBITDA, and then sell at a significantly higher multiple than they bought into it for. It's the same concept, just with real estate. So it's been a nice niche, but as discussed, it creates significant headache, right? There's a lot of operations and systems and programs that we have to put in place to make that work. And then in result, we get a strong moat around that. It's hard for groups to come in. Now, if you're in Boston or New York or San Francisco, LA, some idiot like me at 21 can come in and be a really serious competitor. And I was in New York, right? But that would be virtually impossible to do in Indianapolis, for instance. You could not really go after those smaller deals with the existing infrastructure. It takes years to build that out, and it took a lot of effort to get it there. But that's where we are now. So we're at an advantage, but it's still an uphill battle to get good deals in the door.
That's incredible. I didn't know there was that much inventory available. That's incredible.
Yeah, it's shocking, but so many of the secondary and tertiary cities, I mean, primary cities as well, there's just a ton of multifamily housing stock that's in smaller properties. And you see it when you walk around a brownstone neighborhood, but it doesn't really occur to you just how much, like what percentage of that housing stock is in smaller properties.
That's amazing. Huge opportunity there. You described Terra Capital mission as institutionalizing the sub-institutional space. For listeners that don't understand that and don't live in that niche, what does that mean?
Yeah, so the best example I can give you is single family home aggregators. So in 2005, nobody bought single family homes as an investment, or maybe you own 3 houses that you rent out or something like that. Then some groups saw that there's a big opportunity. There's a bunch of very inexpensive single family homes that with a little bit of effort, they're located in really good school districts. So people will rent for a pretty strong amount. And it actually, turns out to be a great yield. And then before you know it, you've got single family home aggregators with 10, 15, 25,000 single family homes in their portfolio. And that is an example of institutionalizing something that was previously sub-institutional. The vast majority of homeowners were and still are individuals, and there was no way to get institutional access to the single family rental market. Now there is. I think one of the next frontiers that's major for real estate is the sub-institutional multifamilies. You took care of the 1-unit properties, but the 2 to 75, the 2 to 100, the 2 to maybe 200 unit properties, that is a space that's very difficult to get institutional level quality access to. And that's our long-term mission, is doing that. It's very profit motivated for sure. I won't lie to you about that, but there's a lot of benefit that brings to the community and the resident base. I mean, you'd be shocked at how many of the units that we come into, call it a 50 unit property, you'd be shocked how many of those units are down units, unrentable, and the landlord does not have the cash available to renovate it to a place where it's habitable. It brings a lot of very well located units online. It also brings a much more professional owner and management structure to tenants. And then it also, there's properties on every block that are a blight, that, 10, 15, 20 unit property that's just a blight, and nobody can get in touch with the owner. It's impossible to, nobody knows what's going on. The rest of the neighborhood's improved, but that building's lagged behind. We go find that owner, we make a deal with them, and then that property becomes a functioning, rentable part of the neighborhood again. So it's a really a win-win-win situation where I definitely win, and that's the most important part, of course. But yeah, everyone wins from professionalizing this part of the market.
That's beautiful. I love what you're doing with the communities and just helping to really bring them back up. So why the Midwest, right? Why does the Midwest continue to offer attractive value add margins where other markets have compressed?
Yeah, so the Midwest is boring. It doesn't make big changes. It's slow. It got completely ravaged in the 80s by steel and a bunch of other manufacturing going overseas. It really hit kind of a rock bottom in the early 2000s as a result of that, right? And there's a lot of places in the Midwest that I would not be interested in investing, but there are certain places in the Midwest that have built back very well, and they've done it in a slow, gradual, long-term, sustainable fashion. The two biggest things there are healthcare and education, right? The cities that have a massive and growing university base, with Pittsburgh, Pitt, Carnegie Mellon, Duquesne. I mean, this is very much so a college town, even though people don't think about it that way. Columbus, everybody thinks of it as a college town, OSU. And then Indianapolis, I mean, IU's, 40 minutes away, but there's a ton of IUPUI and a bunch of other schools that are local to Indianapolis. And then the healthcare systems are hugely important. So OSU Health, UPMC, which is one of the largest, fastest, most rapidly expanding and heavily investing medical systems in the U.S., and the IUPUI nursing program and all of that stuff you have in Indianapolis are huge. So they're really a recession resilient, continue to employ well, but you're not seeing, 6, 7, 8% population growth, and you never will. Like, that's not what that place is like. It's, the cities that have come back well, and the ones that were invested in were not that majorly impacted during the financial crisis, and they won't be as majorly impacted as a lot of other cities in the U.S. during whatever the next downturn is. They're recession resilient. They're built up on very steady job flows. And I think the other thing that makes us excited about these 3 cities is the next gen industries that are in them. So Pittsburgh's got robotics. Indianapolis has got an insane amount of pharma. Eli Lilly, which is a Zepbound producer, is there, right? So they're on track to be one of the highest performing pharma companies over the next 5, 10, 15 years. And then Columbus has a thriving tech VC. Anduril is based there. I mean, that market's growing very quickly. So they have the opportunity to continue to grow and continue adding high value jobs, which is huge. And I think they're all going to be big data center locations. I mean, there's a massive Amazon and Google data center going in Indianapolis, and that'll continue to keep those markets uplifted, which is great. But I think the major thing for us is that the supply demand picture long term is great. I mean, the population growth is not really large. And so you're not going to see massive developers coming in and putting in these huge, new developments or apartment communities. And that makes a value add existing site investor and renovator. It's a haven for that. It's beautiful. There's not going to be a tons of new units coming online. Rents will stay strong. And the basic math of where you need to buy per square foot, what you need to renovate per square foot, and where you can exit and cash flow per square foot stays relatively constant with a steady, 2 to 4% increase every year. That's why we like those markets. I think similar to the earlier discussion about building up the systems necessary to operate in the call it the lower middle market of multifamily, you don't want to be in a place that's changing rapidly for better or for worse. You want to be in a place where it makes sense to plant your flag because you're going to be able to operate there for the long term. And then all of your years of investing in operations and people and vendors and contractors actually pays off. So, we love all of those things about the cities that we're in. Last thing is regulatory. I mean, these are cities where it's very landlord friendly operationally. And one thing that I think has been surprising for us, but is huge, I think in states where we're really worried about insurance and property taxes going up, definitely has happened in our cities, but to a much lesser degree. And there's regulation in the pipeline to curb that or even reduce, assessed values, especially in Indianapolis and Pittsburgh. Pittsburgh, it's already happened, so great. Indianapolis, it's on the horizon. And insurance costs are not as skyrocketed in the Midwest as they are in places that are more prone to natural disaster. So if you pick the right insurance provider and don't go with a national, you can keep your insurance costs relatively flat. So there are a lot of things to like about it. Now, it's never going to be Austin, so you're never going to hit a 4x return unless you just buy insanely well. It's not going to happen, but you are liable to regularly hit 2x returns on a 3-year hold, and that is where we like to sit in there.
Incredible. Sounds like you have those 3 locked down. Are you looking at any other markets currently? I mean, what about Cleveland? What about Cincinnati? What about those places near to you?
Yeah, Cincinnati's great. It's a little small, and is a little touch and go on where it is. But yeah, we've looked pretty seriously at KC, Louisville, Milwaukee, even St. Louis has been on the roadmap. And, in the future, I think we'll probably add 1 or 2 of those. But for the short to medium term, there's so much meat on the bone in the cities where we are that we probably won't do it. I mean, Cleveland's a great example. St. Paul is the best example of the tale of 2 cities in the Midwest. I mean, I love Cleveland, go Browns. It's still, in my opinion, one of the best places in the world to live. But because of the way that local politics has worked and the way that the city's been operated and what's been offered to large companies, there just hasn't been a major expansion in new employers coming to town and filling in the gap of the, Rust Belt situation. Just hasn't been able to happen. And places that I think are naturally less well suited to a next gen city like Pittsburgh have taken up the mantle there because of what the city council has been able to do and get new employers in there and make it easy for the large universities and hospitals to continue to invest profitably. Cleveland Clinic is huge, but it can't alone hold up the entire Cleveland economy. So it's one place that if things turn around, I would absolutely love to invest there. And this isn't a podcast about how great Cleveland is, but it's right on Lake Erie, which feels like the ocean. It's got beaches. There's a great boating culture. There's 3 major sports teams there. It's a very fun going out nightlife area. It's an awesome city, and I would love to see it make some changes and be the type of place that could be on our radar in the next 10 years.
Awesome. Ray, when you're evaluating a sub-institutional multifamily deal, what are the signals that tell you this one is worth fighting for?
Yeah, I think what the number one thing is how much renovation is going to be required to stabilize the asset. You can buy whatever price per unit you want, but at the end of the day, what really matters is your TDC, your total development cost per unit. And that includes all of the closing costs and everything, of course, but most importantly, your renovation budget per unit. And when you're hunting in a good place and you're going after relatively small assets where the competition's not crazy, where you really become the sole person in town that can buy that asset is when it's too much work for everybody else to take care of, right? So we're not afraid of putting in 30, 40, $50,000 per unit. We're not afraid of replacing MEPs, mechanicals, plumbing, electricity, whatever. We're good with doing that work, roofs, decks, etc. It scares off a lot of buyers. Mostly buyers want to come in, do a little bit of light renovation work and just take all the upside and rent. It usually doesn't work that way. Usually they underbuild and it doesn't go the right way. But if you have an opportunity where you're the only person that can do that work, that level of work quickly enough and well enough, then you're going to be the winner every single time. And so when I see that, that's when I get really excited about a deal. And like that one I was telling you about right before we started, that is a new deal we're working on in Pittsburgh that looks really exciting for us. That's very much so the case there. There's tons of MEP replacements that most investors won't touch with a 10-foot pole. It's already got so few people looking at it because it's Pittsburgh in the first place. And then it's too small for the larger groups to even be focusing on it. So, I'll be competing against maybe one or two other groups and more so competing against myself to get the best price per unit.
That's awesome. Let's flip the switch a little bit. What are some of the red flags that immediately kill a deal for you?
Yeah, location, there's just some things you can't solve with good operations. Crime, squatters, fraud, all that kind of stuff. You're never going to win that battle. Properties that have been value added or renovated, but the rents haven't really gone up, which you can see in the first data set that comes over. You see tons of deals like that, especially coming out of higher interest rates where groups are trying to bail. Those you can always tell are going to be bad. And then really large ones or extremely good shape properties that have been super well managed, like I'm not going to go take a look at those. If I was trying to deploy $1 billion and needed to put it to work, I could do that in small multifamily, buying, cash flowing things to be fine. That's the market that we sell into. It's a thriving market. It's great, but I'm not that buyer. I want to do the work and I'm going to get the reward for it.
Of course. You've been doing this since 2015. Today's environment is very much different. From where you sit, what are the most misunderstood risks in today's multifamily landscape?
Yeah, that's a really good question. It depends on where you are, what the biggest risk is. I think a lot of the cities that have gotten tons of attention over the last 5 years, especially in the Southeast, Southwest, and coastal cities, I mean, a lot of those risks have come to bear, right? You've got huge population growth, but the population that's coming in isn't good. They're not high income earners, and you're trying to build A plus properties, and they can't afford it. So, you're just a affordability crisis created simultaneously by building properties that are the rent's too high, and then incoming population where the median income is so low that the percentage of median income that's taken up by rent instantly becomes unaffordable, right? So, that is probably the number one thing on that list I would put.
That's awesome. In the sub-institutional deals, operational execution makes or breaks returns. Where do you see the biggest value creation levers in these smaller assets?
Yeah, the biggest value creation levers are the stuff that you probably take for granted in a luxury building, but people really want. But if they can get that at a 30% discount or 40% discount to living in a luxury building, they'll do it. So, your flooring, your quartz or granite countertops, you're actually having a backsplash. It's not that expensive to add some of those things. Other ones are. Quartz countertops are very expensive, but it goes a long way in rents. I mean, that's a 25% difference in rent when you do those things. And then big ones are modern HVAC systems. So, at the very minimum, mini splits, but ideally, furnace and or PTAC unit, and having in-unit washer dryer is massive. So those are the biggest ones. There's a lot to be done in curb appeal that goes a long way, and we do that work and it turns out very well. But being able to live in a near luxury quality unit in a property that doesn't have tons and tons of amenities, whatever, but to be able to do that at a 35, 40% discount versus a luxury property is huge, especially in the Midwest, but anywhere where affordability is important, whether that's culturally or economically.
Incredible. Is there one operational mistake that you see over and over from new GPs?
I would say that the vast majority of mistakes happen during the deal selection, underwriting process, and vendor selection. I mean, underbuilding, overbuilding runs rampant. I see those deals popping up back on the market all the time. Going with I think GPs that don't own their own management firm it's problematic. We tried that, didn't work, switched, bought a property management firm, and now we're fully vertically integrated and have been for 8 years. We manage all of our own properties, and I literally don't understand how it can be done any other way unless you just get extremely lucky or nail it picking the right property manager. And I think part of the deal selection piece is picking a location that's going to have the right tenant base for your management style and being able to cater to that well. I think there's a lot, whether it's internal or third-party management, of just not having the right systems in place for that tenant base, whether that's affordable workforce housing, sub-lux, lux, whatever it is. I think there's tons of mismatch there. And it's one of those things where if you're a good deal guy, so you go out and do a bunch of good deals, but then you don't have all those other things in place because you're not an operations guy, that's a problem. And that's where a lot of deals go south. You really can't just be the deal guy or just be the operations guy. You've got to have everything working in concert, or you're just going to either have a lot of problems or leave a lot of opportunity on the table.
Yeah, absolutely. I totally agree. So you work with multiple levels of investment stacks. From your perspective, what actually builds trust with LPs today?
You got to send them money. You got to send them regularly, and when you sell, you've got to sell for twice as much as you bought it for, and that's if you do that consistently, then you're in good shape. I think that's a cheap answer. Obviously, a lot of communication, being very open, not oversharing, but making sure that you're communicating with that LP the way that they need to be communicated with is key. And if there is going to be a long-term problem that's going to meaningfully affect returns, you've got to start that conversation early, make sure they're aware of what's going on and why it's happening. And that builds trust even through a mistake, right? So deals that don't go exactly where you want them to go, if that conversation was there, then they'll still give you money for something else and expect that to do well. Those would be the main things. More than anything else is you've got to actually pick good deals. You have to actually operate them well during renovation and during management, and you have to sell them well, and that's your job as a GP. So if you don't do any of those things right, then you're a pretty lousy GP.
Still sticking with the LPs, whether the behaviors immediately create doubt and hesitation in the LP's mind.
Yeah, I think the number one thing is a lack of communication or slow communication. I think that is one thing that, as an LP myself, when I see that, I think, okay, that's not so good. There's a reason why that's happening. As a GP, when I've got news, it's typically good. So I'm bragging about it. Like, I'm trying to be communicative about it. That's what you want to see. When that happens, I think that's bad. And then, I think not doing something that you promised you were going to do, even if it's something small like this, that we're going to fix this before the winter at this property. And then, you come out for your Q1 review and you announcing that, this thing hasn't been fixed yet. It's just like, okay, do what you told me you're going to do, or else it's just ridiculous. It seems like you're twiddling your thumbs, sitting on your hands, not doing any work. And so part of that is executing on what you promised, but part of that is also not promising on things you can't execute because you didn't think about it in advance.
Yeah, you nailed it. I had a previous guest on, and he has a platform where he evaluates GPs. And the number one complaint is transparency and communication. Awesome. Let's talk a little bit about what do you see in the next 5 years. So, when you look ahead 3 to 5 years, what's your working thesis on where sub-institutional multifamily is headed?
I think it's gaining a lot of traction and interest. I think it suffers from not having large enough deals for institutional sized groups to participate in on a one-off basis. So I think you'll see more and more funds circling around that space. We have a committed capital fund for 50 units and less. It's just impossible to do that on a one-off basis. Larger deals we've done on a one-off basis. I think you'll see a lot more headed in that direction. I think you will see, just because of the silver wave, a lot of these smaller multifamily properties coming to market because of folks passing away, folks retiring, folks trying to move to Florida, whatever it might be. A lot of these properties were bought in the late 90s, early 2000s for the last time. And that means that those people and they bought it for a forever vehicle, but they're ready to retire. So I think you're going to see a lot coming to market. I think you'll see groups that are already positioned as an expert in Jacksonville, Florida, be able to take advantage of that more than, a group that's never been to Jacksonville, Florida before. And I think you'll see a lot more interest in larger funds, pensions, institutional groups trying to get exposure and figuring out that they have to do that through a fund structure. So I think you'll see it become more and more institutionalized the way that single family home aggregators were. But it's larger properties, so it's still stickier transactions. It's not going to be a 5-year thing, and it's the next single family home aggregation play. But over the next 15 years, I think it'll strongly be in that position.
Awesome, right? A lot of our listeners run smaller shops, right? 50 unit deals, 2 million, $10 million checks, right? What
Yep.
lessons from the private equity world do you think translate best to these operators?
I think trying to get as much scale as you possibly can in as dense an area as you can do it while still doing good deals, which is way easier said than done, is the name of the game. I think where you struggle is when you didn't put enough units together by hook or by crook, and now you can't hire that really good property manager to run the portfolio, or you can't hire that best contractor to do a really good job, and you can't hire a team of 4 maintenance people because you don't have enough scale to do it. So that's the number one thing. Scale is everything. Everyone says, don't look at a deal unless it's got at least 100 units. I think that's bogus. But if you're going to look at a deal that's lower than 100 units, don't look at just one. Make sure you look at least 100 units worth of it to make it at least some level of scale. And for 300 units, 400 units in the city is the minimum scale where you're actually operating at a healthy cash flow and headcount level.
That's great advice. I mean, if you were advising a younger operator today, what would you tell them in order to position themselves ahead of the curve?
Yeah, I would say figure out what connection you have in your life that's good to capital and figure out something that works for that capital. And it's really hard to just go out and get enough money to quickly get to the 100 or 300 unit level unless, you're smart about it and use your own connections. So if it's your family friend who is interested in getting into multifamily or whatever, but they only want stuff that's built after 1990, then don't try to go to market with a 1970s build. Like it's, match the whatever capital you can get, and everything will build from there because word of mouth, you'll have the resources to go find new investors, XYZ, but find that first capital and try to build towards that.
That's solid advice. Thank you for that, Russ. So what are you doing with AI? Are you using any systems right now? And how are you operating with AI right now?
Yeah, we are doing a lot with AI. And I would say that at the very highest level, it's been difficult for tech to break into real estate. I think it's going to remain difficult for AI to break into real estate. I think groups that do too much on the AI front are going to end up being losers in the long run. And groups that have human touch where they need it are going to end up being the winners in the long run. And I also think that the expectations around old school style, somebody sitting in an office in your building and that's the person you go knock on their door and tell them about your problems, is going to become less and less and less the expectation for tenants. So what we've done instead is where we need the physical presence, we have the physical presence. Where we can put somebody on the phone that's an offshore resource, ideally somebody that is, very, very fluent in English, maybe even an American expat in Panama or wherever it might be, having that person ready on the phone 24/7 and making sure that they're AI enabled to help answer questions live, which is easier said than done. I mean, the level of AI uptake in the world is very different depending on where you are, depending on what type of person it is. So you can really have a super powered, very smart phone operator that's AI empowered, and you can also have the exact opposite and kind of be spinning your wheels. So I would say that empowering our employees with AI has been huge, not replacing them. We'll probably have fewer than we would have otherwise, sure, but not replacing them, keeping the live on there. And then wherever we can use AI to reduce costs on the back end, we'll do that. But I think the number one thing that I can say for introducing AI in real estate is go only with vendors and processes where that vendor has tons of clients and is large. There's tons of AI startups that they want your business. They want to grow, but they're probably not going to make it. So you really don't want to go with them and then have to change all of that systems later. Go with a group that's plugged into whatever property management software you use. Right now, I think AppFolio is the number one choice, frankly, for property management software. I think a lot of people agree with that. And they have a lot of good AI and AI enabled plugins going into that. And that will make you more effective and more cost effective if you just stay in that realm. Let the AI guys do it. Try not to build too much stuff yourself, and avoid many of the smaller groups that are just getting started, because they're probably not going to be around that much longer, and you're going to end up being a guinea pig while it works, and you'll lose. We talked about trust with LPs, which is important. Your trust with your tenant base, which is just as important.
Yeah, that's huge. So are you using it for underwriting? Are you using it for lead gen?
Not really much for underwriting. I think especially in the lower middle market space, you really need to underwrite things the old fashioned way and understand all the nuances. And when you're wrong, you got to know why you're wrong. When you're right, you got to know why you're right. And when you're lucky, you got to know that that's what happened. We're using some of it in lead gen. About 70% of our units we buy fully off market, direct to seller lead gen, which is a lot. And as a result, we have put all third party vendors, definitely, but a lot of AI input into our letter mailing campaigns, our cold email campaigns. We don't do cold call and cold text. Invasive. People in the Midwest really don't like it. And that's worked out well for us so far. Do some cold calling only on larger properties where you're not going to be disturbing somebody's dinner, giving them a ring because it's somebody who owns it professionally. We would never put like an AI agent on that phone call, but we would definitely do some AI in the background to help prioritize the call list for the live caller.
Amazing, Ray. Two-part closer. First, what advice would you give to an LP looking to invest passively in today's environment?
Yeah, if it's specific to real estate, then I would be very careful about cap rate and yield on cost. Yes, you want higher for those things, but definitely don't go after the ones that are so low that there's no mathematical possibility of them covering their debt service. Obviously, don't do that. But then if you're going to go after one that's sane, sometimes there's a reason why the yield is so high, and it's because there's a lot of risk in there. And sometimes the yield is so high because they're buying at a relatively low price. So, don't just go in and pick the operator that you think is smoothest or has the best pitch or whatever. Actually take a look at the deal, or if you're doing a fund, take a look at some of their past deals, so you get an understanding for like whether they're putting lipstick on a pig, or whether they're buying really risky areas, or whether their underwriting is just way too high of a rent or way too low of a renovation cost to make something work. Past performance is not a guarantee of future performance, but if they've performed well with something that they've bought in the last 3 years, is probably a good sign. If they perform well with something they bought in 2012, then they're everybody, because the market's done so well since then. But that would be my advice, and then also try to pick markets that don't have tons of inherent risk in them, and that haven't been the ones that are super hot and you always see on LinkedIn, you always see on podcasts, stuff like that. There's a reason why there's that many people talking about it, and that's because it's already been over invested. So you need to go pick something else. I'm not saying only the Midwest, although I think the Midwest is a great opportunity, but you've got to pick a location that's not over invested.
That's fantastic. Second, let's flip the switch. What advice would you give a smaller GP who wants to build long-term reputation based business in value-add multifamily?
Yeah, whatever type of capital you can put together to do your first deal, just knock it out of the park, then knock out the next 5, and at that point, you should have some good momentum to keep going. You can do the whole podcast online approach to build brand awareness, which is great. I think it works for a lot of people. But at the end of the day, you've got to buy this set of brick and stone and wood at a good price. You got to put the right brick, wood, and stone into it to make it look better. And then you've got to sell it for more money than you put into it. And you have to be able to do that repeatably, or else it doesn't matter what your reputation is. You don't have a product to sell.
That's solid. For Ray, this has been excellent. For listeners who want to learn more about Terra Capital work or connect with you, where's the best place for them to reach you?
Yeah, so exactly opposite of what I just said. Definitely find me on LinkedIn. and follow Terra Capital on LinkedIn because I'm an anti-social media guy, so I'm not really doing that much stuff on there. But our analysts do put out some good biweekly newsletter that talks about multifamily, especially in the Midwest, but has some great info on there. I read it more as a consumer than a producer at this point, and it's really good stuff. But it also, keeps up to date on what we're doing. And if you want to add me on there and drop me a message, fire away. Otherwise, subscribe to Terra Capital on there, and you can keep up with us.
That's fantastic. We'll drop everything in the show notes. Ray, thank you again. This has been a masterclass in disciplined multifamily investing. This has been the AI Edge podcast. If you got value from this conversation, share it with another investor, operator, or LP who needs to hear it. See you on the next episode. Thanks, Ray.
Thank you. It's a pleasure.